put the spotlight on a sector we were just talking to Mayuresh about, which is insurance. Raghvesh from JM Financial is joining us on this to discuss it, and it becomes crucial because look at what's happening with ICICI Pru this morning, and that fear continues. Harsh joining us first to highlight key trends that we're seeing in this pack.
Well, first off, Tamanna, returns have not been great here. Since budget of 2023, since the introduction of taxation provisions with regard to life insurance products, certain ones, you've seen life insurers under pressure, and they've constantly been under pressure. The kind of stock movement has been very, very range bound. And that's also led to some shift with regard to product mix, some changes in terms of regulation, including the surrender value regulations, where there was large amounts of overhang. Would be curious to know whether some of those overhangs have actually gone away or do they continue to sustain, and whether now, over the next 2 to 3 years, the growth runway is cleaner, both with regard to profitability, which is your value of new business as you quantify it in insurance and life insurance terms, as well as with regard to top line. Can you continue to do that? There's also some bit of overhang with regard to possible restrictions with regard to the banking channel distribution. Whether that will come or not, it has been a big concern. So some of these, and who will adapt the best, and whether valuations actually look decent now, given the kind of flat line that some of these stocks have moved at, is something I'd be curious to know.
Okay, some key questions to actually put forward to Raghvesh, who's joining us. Raghvesh is insurance and AMC research analyst at JM Financial. Raghvesh, great to have you on the show, and very good morning. Thank you for your time here on NDTV Profit.
All right, good morning, and thanks for having me.
Sure. Let me start with an overview before we get to the specifics, and of course we'll speak about ICICI Pru, which is getting a hammering today. It seems like a choice between the devil and the deep sea. And I say this because insurance companies, after regulatory changes, etc., and because of demand, want to sell a product that gives them lower margins. And that pain will continue for some time, isn't it?
If we move back to, say, a couple of years, FY 22, the budget imposed taxation on ULIPs. At that time, the concern was the ULIP, which is a good 30-40% of the business for them, that tapers off and the growth for the sector comes off. Now, what happens today is we are saying that ULIP mix is rising, so the margins are coming off. See, the industry has adapted over the last 3-4 years, as they have adapted over the last decade. There are some changes which are happening in terms of the VNB margins coming off with a higher ULIP mix. However, I would not look at that as a negative. See, ULIP is a shorter term product as compared to, say, a participatory product or a non-par. So the margins which we are talking about comes from, say, a 10-year period compared to a 20-year period or a 25-year period for a traditional product. After 10 years, the customer is back to you. You can sell him another product. So actually, the sustained value for the business is generating over a period of time does not reduce. So while we may see margin pressure here and there, over the period of time, as long as they're able to sell the products, as long as there's a demand for the products that these guys are selling, we see a sustained growth. I mean, these guys have consistently shown a 14-15% growth, 2-3% above the nominal GDP, have largely maintained the share of customer wallet in terms of the share of financial assets that are going into insurance funds. And we look, and at this point, we see consistent 15-16% growth for the private sector going ahead.
So Raghvesh, are you saying that from here on as well, when you're looking at an insurance sector, avoid looking at the margins, because the margin trend will be skewed and they will continue to focus on achieving sales?
See, the absolute value which a business is generating is in terms of the value of new business. In life insurance, we use this compared to a PAT metric because a lot of the value occurs over the period of time. Say a typical product for them is, say, a 25-year product, a traditional product. While we keep saying that the margins have come off, if you look at the growth numbers in terms of VNB, it's pretty decent at around 14% for HDFC Life, high single digits for some of the other peers that have come in. So as long as the VNB is growing, there is another part of the book, which is the value of the in-force business, which is all the policies that have already been sold, and they bring an investment income to the embedded value. We see a sustained 15 to 16% growth in terms of embedded value for the wider ecosystem. For the leading players, we are seeing anywhere from 17 to 18% growth in embedded value, and that translates into stock market performance going forward.
Let me come to you on ICICI Pru, Raghvesh, because I think that is top of mind today in terms of the extent of crack. The pain point when you see the key metrics is that sequentially their margins have come down, and that was expected because you're changing the product mix. Do you see it as such a big negative? Just want to know your assessment of the numbers.
So thinking about some of the results which have come in the insurance sector, across the board, we have seen ULIP share rise through the year. In fact, starting from FY24, the ULIP share has risen. For some of the players like say an HDFC Life, the share of ULIPs in the savings business has come off coming into 3Q. And that will play out for all the players with a lag of a quarter here and there. It also depends on the channel mix, which channels are selling which products more aggressively, or where the demand is there for these products. We can also take a view on the equity markets that with the SIP inflows coming in, maybe that is a reflection of how much a natural demand is there for the ULIPs. But again, as I mentioned earlier, ULIPs keep the customer engaged. There is a change in the NAV of the product, so that customer is constantly in touch with the insurer. You sell a ULIP today for say 10 years to a 40-year-old customer. You sell another ULIP after 10 years. At 60, comes back to you for an annuity product. And you are able to keep the customer engaged, not just to the insurer, but even to the wider ecosystem if you are part of a bank group or an insurer-led group.
So Raghvesh, when you talk about ULIP heavy, specifically for ICICI, right, that's been the case. Now, if the growth challenges persist, and if the natural demand for this product comes off, will it be ICICI which will be beaten heavily as compared to a HDFC Life and a SBI Life? Because that's the nature of the products that ICICI has been selling.
See, the products have evolved over time. Like HDFC Life, a couple of years back when they were selling, they were very specific about the share of ULIPs in their mix, because they were not able to generate the margins, and hence their VNB growth used to suffer. Now, when they are able to, with the natural demand for more protection in terms of higher sum assured on the products, in addition to just the saving component, and a demand for say a health rider along with the ULIP product itself, the margins for that business has improved. And now we can see that in say an HDFC Life that their VNB margins at a blended level have improved. And I think that is what should play out for all the other insurers as well going forward.
So Raghvesh, what is the street taking negatively that the stock of ICICI Prudential is down to the tune of almost 10%? What are the markets reading negatively? Because valuations are not expensive as compared to peers as well. And with that, if you see in terms of the quarter, the numbers look pretty decent. So what are you reading?
See, when we look at the entire life insurance space, the overhang that we had a bit of concern around whether there will be a cap on banca, which you were discussing earlier, that was the key before coming into the results. Coming into the results, the commentary from the peer insurers has been that there's nothing specific on this, and they expect banca business to grow in double digits going into FY26 and beyond. With that, the stock, that a lot of re-rating for the sector has already happened. Now, perhaps there is a concern that in the budget, we may have something negative for life insurance. Maybe people decide to wait for a quarter, but the fundamental value kind of stays intact for the life insurance sector. And when we are talking of 15-16% kind of a floor on the EV growth, the valuations have to catch up. at some point.
So Raghavesh, when you mentioned that there is an anticipation there could be some negative announcement that could come in the budget, what is it that we should be watching out for?
There is no anticipation of a negative announcement in the budget as far as I have been hearing. What we expect from the budget is perhaps something along the GST cut, which has been in the news for some time. The products under life insurance and health insurance are liable to pay GST at rates of anywhere from 2.25% to 18%. If that comes off, it will be a positive for the sector.
Raghavesh,
Yeah.
that's a decision the GST Council will make. So
Yes, but there is a discussion along those lines that it may come with the budget. Among other things, the income tax slabs, there is an expectation that there's something comes along a direct tax code, something about the new income tax regime getting better. However, over time, we have seen that around more than 70% plus people are already there on the new tax regime who do not get a benefit from saving through insurance products. And as a result, we have also seen that over time, the share of people buying insurance products in 4Q has reduced over time. So a number which used to be, say, 38% of the sales would come in 4Q has reduced to somewhere around a 32 to 34% number recently over a 6-7 year period. So I would not be very worried even if a direct tax code or the new tax regime is made more attractive to the individual taxpayer.
In a comparative situation, Raghavesh, and let's look at some of the peers there. We talked a bit about ICICI Pru. Let's look at SBI Life. I don't know if you look at a Go Digit Insurance because that has also been buzzing, and others in that space. How would you rank them? What would be the comparative overview that you can give us and your top pick there?
So in the insurance sector, broadly, we are very positive on the life insurance and the health insurance space. Both are essentially consumer-facing business. Long runway for growth have shown consistent growth over the years. We prefer the larger names because, as we were discussing, there have been concerns around how the caps around expenses of management, what they can pay out to the distributors, how that plays out. So my top picks would be the larger players within the insurance space, the private sector, someone like an HDFC Life, a Star Health, and SBI Life in that order.
One question I have, Raghavesh, is with regards to valuations in terms of the life insurance companies. Absolutely low right now versus if you look at the last 4 to 5 year average. The quarter has been decent. Clearly, the stocks have been beaten down. Taking this combination into consideration, do you think this is the best time for an investor to start allocating to insurance as a sector? And if so, I come back to Tamanna's question in terms of your pecking order, if you have to look at the topic.
Yes, I think it is a good time. A lot of the concerns which were there, I think much of the last year was spent discussing about how the surrender norms will play out. The companies which have reported, HDFC Life, which was expected to have a hit of up to 100% on their VNB margins, have come out saying that the maximum hit that they can see today is a 30 bp impact on VNB margins, which is very small. Somebody like an SBI Life, again, as we were discussing, higher ULIP share, hardly any impact of the surrender norms. So that has played out. I think that is what a lot of the street was waiting for. We spent much of the last year calculating how these numbers would play out. Now I think on the base of last year, the companies have delivered on growth. Like private sector for the 9 months has delivered somewhere around 19% growth. Even on a 2-year CAGR, it's around 16%. That should translate into VNB margins going forward as the product demand stabilizes, the product mix and the product bouquet for the players have actually evolved very well over the last couple of years. And from here, as we were discussing, around 16-17% growth in embedded value for the top players. and with consistency around one, the APE growth, VNB growth matching the APE growth number, and the embedded value growth slightly ahead of that, we see the consistency being rewarded by the markets. Again, to reiterate, top pick would be HDFC Life, followed by a Star Health, and then an SBI Life.
HDFC Life, Star Health, and then SBI Life. All right, so that's
SBI
what
Life.
making. All right, thank you, Raghvesh, for joining us. I mean, clearly ICICI Pru is not in that list. 8.5% down right now. Markets overall, at least I would say, top line recovery from lows.